Hello and welcome. You are watching KYC or Know Your Company. My name is Puneet Zaveri, and over the next half an hour or so, we'll try and put the spotlight on one company that you need to have on your radar today. Before we move on and do all of that, it's important to look at which company are we talking about. It's a very, very hot sector, a very, very hot space right now, and that is the EMS sector as a whole. We're talking about Epack Durable, a key company in the consumer discretionary space. They are key manufacturers AC, but before we do all of that, a little bit of history about the company. It was incorporated back in 2003, began as a contract manufacturer essentially of consumer durables, which includes AC amongst other key products. Now, when you look at what the company has focused on, it has largely been the room air conditioner space, and even post-listing, it was a meaningful part of the company's revenue and margins as well in that aspect. But post that, in 2012, they later transformed into an original design manufacturer. It essentially means that they designed the product for other companies in the AC space like Voltas and Blue Star and designed the product as well, which is a high margin business. Now, this was of course founded by the Singhania and the Bothra brothers, and we will be speaking to Ajay Singhania in just a bit. But important to look at, what are the other clients that they focus to. So all the room air conditioner clients like Voltas, Haier, Philips, amongst others, Godrej, Daikin, Havels are all the company's clients, and these are just some of them. When you look at the key products though, over the last few years, they have diversified away from air conditioners into large domestic appliances as well as small domestic appliances. The large domestic appliances do include products like washing machines, while small domestic appliances have water purifiers, air coolers, amongst other key products. This has been a key diversifier for the company, and that's very, very visible in terms of revenue. Now, it's been a tough year for the company, largely led by a longer period of winter, shorter summer, a bigger monsoon. So AC sales do get impacted, and that's reflected in the 36% downtick that we've seen in the AC revenues. But because of the diversification in appliances as well as the other key segments like components, that has helped the company in somewhat way to reduce the losses. So while the AC segment is down 36% in terms of revenue, the total revenue is down only 15%, led by the high growth for the appliances as well as the component space. And that has been the one key differentiator. Although though, the key problem is that there have been a key concern on the financials of the company because of this aspect. Over the last few years, AC concentration has been key, but that has impacted the company's margins at this point of time. So when you look at the rating parameters, with the funds which we'll be focusing on and diving deep into what's impacted the business, is going to be key because the company's share price is down 49% in this particular time frame, and we'll focus on a lot of that. But income statement, balance sheet, cash flow, return ratios, if you're a regular viewer, you know a bit about this. Shareholding, street cred, valuation, and finally, what do analysts actually make out of Epack Durable? When you look at the first key parameter, that's income statement. Now, between the 3-year CAGR, if you see, the performance has been quite strong. 33% growth that we've seen just in terms of revenue. The EBITDA margins have also been substantially scaling to 7 to 8%. While FY25 did have a blip, it has been a good year overall on a 33 to 48% growth in terms of a CAGR growth, that is, in terms of revenue and profit. So why the neutral rating? In the last few quarters, it's been a difficult performance for the company, and margins as well as net profit has been impacted just for this specific quarter. Quarter 3 saw 427 crores in terms of revenue, but profits were impacted, and that's been one of the key concerns for Epack Durable. We have been talking about the impact in terms of margins, but it's also important to look at the balance sheet as well. Now, we've been looking at the long-term borrowing as well as the other key aspect that has increased, and that's visible here. So while the equity portion and the reserves have actually increased going into H1 of FY26 as well, we saw stagnation of this number post FY25. But you look at the borrowing number, that increased and almost doubled from 62 crores to 122 crores at the end of FY25, and the H1 number is just for H1, so that's 33 crores. So there has been an increase in borrowings, and that's because of the increase in working capital. Lower AC sales, it means that the inventory is higher and a lot of money gets locked into that. Hence, the company had to borrow quite a bit to include and transfer into that particular period, while the cash bank level has been quite stable at 44 crores, but from the FY24 level, it has seen a quiet dip as well. And hence, we've given this a thumbs down, and largely on the back of lowering the company's inventory as well as borrowing number is something to talk about. When you look at the third key metric, and that is cash flow, we have been talking about working capital as well as the impact of the business in terms of the cash flow from operations as well. So when you look at the cash flow from operations, it has increased to a highest level of about 257 crores in FY25. There you see the dip to 31 crores in FY26. And this is, of course, in FY25, this was H1 of FY26, we saw the dip. Also, the operating profit, the operating cash flow to PAT is the other key metric. After a huge, humongous increase, that has again come down to 56%, while the net cash flow has also been largely stable. So there are multiple key factors happening here. While some metrics are a positive, the cash flow from operations being impacted is clearly a big negative, but we've given the company a little bit of benefit of the doubt, given it a neutral rating for cash flow as well. The fourth metric though, that's return ratios. Now, for a company the size and scale of Epack Durable, there has been a pressure on the return ratios, and the story largely was as the company gets bigger, the return ratios will improve. Well, FY22 was a year we've seen reduction of the return on capital employed over the last few years. With the company's advent into larger appliances as well, the return ratios are expected to improve, but that has yet to materialize. So while it has improved from FY24 to FY25 level, we will have to wait for a couple of years at least to look at a meaningful increase because of these initiatives. So hence, we've given this a neutral rating as well. The other key part is shareholding. It's been largely stable, one where the company has shown immense promise in not selling out at any point. So we've seen some selling between March 24 and 2025, but largely a little bit only at 47.18, company has been managed to keep it. What's also interesting is the increase in shareholding of retail as well as public investors. It's gone from 32% all the way up to 45% and shows the company's interest amongst retail investors. As the share price has corrected, that's also one of the key factors that retail investors do sometimes buy the dip, but it's important to keep track of the metric while domestic investors have steadily reduced their shareholding. Hence, while we have given this a thumbs up rating largely on the back of promoter holding, there is a lot to look at in the changes between public as well as the foreign institutional investors and also the domestic institutional investors as well. When you look at the street cred, that's the other key part. It has been a disappointing picture for investors for Epack Durable over the last few periods. When you look at the number over the last 1, 3 and 5 months, specifically the stock is down 14% in the last 1 month. It has been under pressure, largely led by what's happening in the particular space as well. But even in the 6-month period, the stock is down 34%, almost down 50% on a year-to-date basis. So that's just in the last 15 to 20 days of January 2026, and down 49% in the last 1 year. So investors have borne the brunt for Epack Durable as they've held on to this particular counter. 5-year performance has to have some caveat that the company listed in February of 2024 since then has given decent returns, but given the large what has happened in the last 6 months, we've given this a thumbs down for now. When you look at the final few metrics as we wrap up into looking at this aspect has been valuations. Now, because of the stock price correction, FY27, the next year of financial year 2027, looks quite appealing in that sense at 30 times price to earnings for an EMS company that too. While price to earnings is also visible of that, the EPS is expected to be impacted in FY26. Now, last year, the company in FY25 did about 5.6 rupees in terms of EPS. Consensus estimates are down to just 3.4 rupees, and hence the higher price to earnings metric in FY26 compared to FY22, where hopefully the growth comes back. But because of the share price correction, analysts have, while reduced their target prices, continued to maintain their buy ratings, and that's visible in the calls as well. So they are seeing a return potential of almost 33% as we speak, and hence we're continuing to see that positive momentum, at least from the analysts at this point of time. But it's also important it's also important to look at what the company also has to say at this point of time, and we have the management which will join very, very shortly on this aspect. So you have seen that the company's performance has been impacted. Quarter 3 also had a lack of growth in that sense, so it's important to speak to the management as to what they think could be one of the key positive metrics for the company. Before we do that, the final ratings, income statement, cash flow as well as return ratios do get a neutral rating. Balance sheet, the company will have to improve on that aspect. While the other key metrics, if we can pull that up very, very quickly, shareholding is a positive, valuation a neutral in that point. For FY26, we need to look at the growth, while analyst as well as analyst recommendation has been a key positive. So the overall rating we get at 4 out of 8 for Epack Durable as well. But to discuss in detail about what the company is all about, and we have spoken to Ajay Singhania in the past. Let me welcome the MD and CEO of Epack Durable at this point of time. Mr. Singhania, very good morning to you, sir, and thanks so much for joining in. It's a real pleasure to talk to you at this point in time because while quarter 3 was a tough quarter, you did mention a few positives about you that the company has looked at, and certainly that investors need to watch out for as well. But largely my first question, sir, the last 3 quarters, the first 9 months of FY26, you managed to do a decent performance. But to start us off with, what is the current picture of inventory on the ground? Have you seen reduction in this particular quarter, and is it coming to a level that's largely normalized, or what is the expectation of normality for inventory over the next few months?
So, good morning. In regards to the inventory normalization, yes, Q1 and Q2, because of the unseasonal rains, we had inventory being piled up both in trade as well as our end not getting manufactured. But thankfully, Q3, we saw the uptick, and the inventory movement has definitely started. The order book has been good, and going forward, next 6 months onward, the season sets in. So the market is very bullish that the past is behind us, and the tailwinds are still very strong for the industry. So at 15 to 20% kind of a growth is what I've been repeatedly saying is on the cards for the industry for the coming 26 season, and shall continue for next 5 to 6 years definitely. So next medium to long term, definitely the tailwinds are very strong for AC.
Got that, Mr. Singhania. And you highlighted that over the last couple of quarters, it has been that the industry has been impacted largely because of higher inventory amongst other key issues. But in the short term, what can be the expectations from quarter 4? Because it is a quarter where a lot of inventory is built in by the AC makers. Is there expectation that that is visible, at least to you in the conversations of the first 22 days of January, that quarter 4 could be a decent, at least flattish on a YOY basis? How should we see this?
So quarter 4, definitely we see growth compared to YOY basis. Quarter 3 also has been a growth, and quarter 4 again we see a growth and recover partly whatever was lost in Q1 and Q2. So quarter 4 will definitely be a quarter wherein we'll see a lot of recovery happening, although it will not be possible to recover the entire sales lost. So as a whole, on an annualized basis, we see that the industry is going to witness some shortfall as compared to FY25, but yes, largely recover the loss of the previous 9 months.
The other key aspect, Mr. Singhania, has been that last quarter 4 of FY25, you did about 650 crores of revenue. Now you are mentioning that you are expecting to seeing some growth at least. So could we expect a low double-digit kind of growth expectation? Now I know you can't pinpoint it, but is there expectation of that at least?
Definitely yes, definitely yes. So what I'm saying is the loss of the previous 9 months partly is going to get recovered, although the entire sales loss cannot be. But yes, we are looking at a ramp up in Q4 and recover a lot of cover a lot of ground here.
Is the expectation largely that with this, you'll be able to at least have flat revenues for FY26 compared to FY25? Because it's a big number that you're aiming in quarter 4 of FY26. You are aiming for almost 700 to 800 crores of revenues. You did about 650 in the in quarter 4 last year. So is that the expectations from you as well? And what could be for margins as well, if I can slip that question in as well?
Yeah, so broadly, yes, the guidance is that we are looking at the number you just mentioned. So recover a lot of lost ground on the AC, as well as our other levers are firing very well. So for us, the small and large domestic appliances will component business is something which is helping us cover a lot of lost sales. And at the 3 new diversified segments for us, the LDA, SDA, and components are growing at multifold. So that's what we see as the growth lever going forward as well.
Uh, if you can also talk about in terms of parts, because we've seen for AC specifically, you have diversified into newer segments as well, and that's very visible in the components growth for you. But before that, has there been increase of raw materials because of copper amongst others? How are you navigating that challenge?
So overall, if we look at the AC prices, there has been correction on two fronts for the coming quarter, and definitely the street, I believe the brands are going to increase the prices or have already increased the prices. So it's on two counts. One is the upgradation in the BE norm. So that's like the previous 5-star becomes a 4-star and a 3-star becomes a 2-star. So there is upgradation because of the price correction because of that. It's broadly like 4 to 5% kind of a price correction. And then another 4 to 5% is the price correction because of the commodities, what was done in the last quarter. So overall, we see close to 10% price correction in AC. And any further impact of commodity definitely gets passed on in the next quarter.
Also, Mr. Singhania, one of the biggest developments that happened in the industry has been the ECMS scheme that has come in. Now, we've already seen a few companies get into PCB manufacturing and get approvals as well for it. What has been Epack's plan for ECMS? Have you already applied and are awaiting approval right now?
Yeah, so we have floated a separate subsidiary company called Bumjin Audio Products Limited, wherein we are targeting to manufacture a lot of audio parts, components, sound bars. So that's a part of our application under the ECMS scheme. And the structural approval has already been there, and now we are filing for the further complete plan and everything.
Mr. Singhani, if you can talk a little bit about your subsidiary, as you mentioned, is that largely into audio, or is this something specific to ACs as well? If we can, if I can just hop on that a little bit, is it also into PCB manufacturing, or that's not included in that?
So PCB is currently under our current company portfolio. So we already do PCB as an EMS. We
Hmm.
make controllers and supplies the component. The specific subsidiary we're talking about, Bumjin Audio Products, is a JV with a Korean company called Bumjin, and they specialize in making audio components and sound bars, TV speakers, Bluetooth speakers, and all these things. So we are under currently planned to start manufacturing by the end of 26 or probably Q4 of 27 and start selling these products in India market.
So, is there any plans of venturing for ECMS specifically into a new facility for PCB manufacturing? Is that something that you will take it as time comes? Because at this point of time, we've already seen approvals come in also for for a few companies. So, what is the expectations for Epack specifically going into ECMS via your PCB manufacturing?
So PCB manufacturing is what we already do under our current
So is there
facility. So
another
PCB.
level of capex that we could expect from you to increase capacity? Because and we've spoken to you previously on this, that India is still very deficient in terms of a lot of parts that go into both for ACs as well as for other related electronic products. So the opportunity is quite huge in PCBs, right? So is that something that you've thought about, and any rationale of not going into it as of now, currently as we speak?
So we currently do a PCB assembly, so not the bare board, but we do the entire component, the controllers. And as we scale up our operations, definitely we'll start doing more of PCBs in house. So currently we do for air conditions and our small domestic appliances. Going forward, definitely yes. So the expansion and backward integration would continue, and scale up will happen as and when required. So that's something definitely a focus sector as our component business is increasing. Investments in PCB controllers, the assembly lines will continue to be ramped up under the current facility itself.
The other thing, Mr. Singhania, has been your advent into your LDAs, SDAs, as well as components. Is the expectation that all three of those specifically will have roughly around 30 to 35% of your revenue in FY27?
Probably more than that. So we are as we continue to grow in AC more than the market. So if the market grows at 15-20%, definitely we will outgrow the market. But at the same time, we believe that our SD and LD and as well as the components have potential to grow multifold. And in a medium to short term, we are looking that our AC is like current year, it has come down to almost 60%. We will try to maintain it 50-55% and outgrow our other sectors like the SDA, LDN components. So that should overall contribute to almost close to 45-50% in 27-28.
Now, Mr. Singhania, just a couple of key updates, and you've spoken about this to us in the past. The one is on HighSense. It's a big project for you. You mentioned that almost 8,000 crores of revenues could be accrued over 5 years once the project starts. So the earlier expectation was that project would start in December 2025. You've now said March of 2026. Is that timeline on as we speak?
Yeah, definitely that we are on bang on timeline. So we had maintained earlier that December is the timeline where we're looking to start the trial productions. The trial productions have been successfully completed. We have got all the approvals in place, and coming the current quarter, which is Q4, we are looking at to ramp up productions. So everything is on time. And our ODM sales to HighSense for the AC has already started since last year. And now the HighSense designed product is what is going to get manufactured in the new facility, the new greenfield facility. The facility is ready, the trials are done, everything is online, on track. And this quarter, probably next month, is when we are contemplating that the mass production will start.
Mr. Singhania, what would be the products that would come out first out of this? Because apart from ACs, there are other related products with HighSense as well. So what would be in, just for FY27, if we can talk about, in that year, what is the expectation of the products to start with?
So the new facility, the greenfield facility, we are starting the HighSense designed air conditions, which are a complete tech transfer from China in next month. And then going forward, washing machines, both top load and front load, are going to start within this calendar year 26 itself.
The other aspect, Mr. Singhania, has been on washing machines. Now, that has been a product that's been with you over the last 3 to 4 quarters. But probably what's happening on the street is that the accretion that was expected compared to other EMS players, and unfortunately you are in an industry of comparison, has been one of the key focal points for investors. So for washing machines specifically, while you mentioned about large domestic appliances being a key growth area along with the other two segments, specifically for washing machines, is there any revenue targets that you can give us over FY27?
So the good news I'd like to share here is for the washing machines, definitely, yes, there was some delay in getting the approvals from the customers, but now that is all behind us. From Q4, we have already onboarded, got the approvals for 2 marquee clients, and the production has already started and ramped up in the current quarter. And we see significant quantities and revenue targets. We will definitely revise upward when we do the earnings call for the next for the final annual results. So that's something I'm repeatedly saying that LDA is one segment which we see will grow at a much rapid pace.
And so, Mr. Singhania, you've given us a breaking news, at least on the show today. You've given us something that you've not said anywhere before. So I'll take it with both hands. The other aspect of the smaller domestic appliances as well, the expectations that while it is a higher margin business, because of the prices of those products being so low, it's a big volume game, and it's something that's while you have been an ODM player, you've always been a technology player as well. So the volume game hasn't been one which you've fought with other players. With SDA, that strategy changes a little bit. So any rationale that you can give us in terms of entering that hyper competitive space, and what do you make of it?
So our competitive strength here is our, like you rightly said, the scale and maintaining the leadership position in the appliances, the large appliances like ACs and washing machines. Definitely, we see will take leadership role in next 2 to 3 years. For small domestic appliances, I think the code we have cracked is not about volumes alone. We want to also increase the width and the basket of offerings. So we have a roadmap wherein we are going to introduce a new product, almost 1 to 2 new products every quarter, and increase the basket of offerings. Because that not only helps us cater to the versatile demand of the customer, but also kind of balance the seasonality and balance our quarterly revenues. So the whole idea of what we have been working on is to have uniform, continuous revenue stream every quarter.
Well, Mr. Singhania, you've been very, very honest and upfront to us about a whole host of issues that you are trying to track, but appreciate your time here on NDTV Profit. We wish you the best. Hopefully speak to you once you'll speak to us again when HighSense starts production in March. So a lot more talking, a lot more numbers at that time, but thank you and appreciate your time here at NDTV Profit.
Thank you so much. Thanks a lot.
Well, that's largely, on Epack Durable specifically, a key company in the ECMS space, in the EMS space specifically, looking to enter ECMS as well. But that's all the time we have on KYC. Stay tuned, a lot more action on the other side.